Hello, my name is Chad Taylor, Managing Partner with MDT Financial Advisors here in Houston, Texas. Today I wanted to get on and record our MDT Markets Minute update on a video. So there's a lot going on right now. We've had record highs in the markets, a war premium in oil, and a big inflation report coming out this week. So let's kind of cut through some of the noise and talk about what's going on. First, the big picture. Despite everything you've seen in the headlines this year, the S&P 500 and the Dow Jones Industrial Average both set fresh record highs earlier in the month. We've had a major conflict in the Middle East. The Strait of Hormuz, the Strait of Hormuz, which is the world's most important oil choke point, has been closed, and yet the market is at all-time highs. Why is that? Really, it's just one thing: earnings. Second quarter earnings season is mostly wrapped up now, and it's been pretty strong. Companies, especially the ones tied to the AI build-out, keep delivering record profits right now. And at the end of the day, stocks follow earnings, not headlines, but earnings. Now, here are the three storylines we're watching right now. Number one, oil and the Strait of Hormuz. Talks between Iran and Oman to reopen the strait are reportedly in an advanced stage, but there's still no deal as of today. Brent crude is sitting in the high 80s, well off its panic highs from the spring, but still elevated. And every day that the waterway stays closed, there's upward pressure on energy prices, and energy prices feed straight into inflation, right? And so that's kind of the number two thing, inflation. The July Consumer Price Index report comes out on Wednesday. This is a big one because it will shape what the Federal Reserve does at its September meeting. A hot number or higher inflation, and the Fed under Chairman Warsh, who's already leaned hawkish, could stay on course or worse. And worse probably means, in the sense of the market, they raise interest rates. A cooler number gives them room to breathe. Either way, expect some volatility around that release. And then number three, the labor market. The July jobs report actually showed job losses, which was kind of a surprise, and private hiring has slowed to its weakest pace in months. Now, a softening job market sounds like bad news, right? And for job seekers, it is. But for the markets, it can actually push the Fed towards an easier policy. It's a strange world where bad news can be good news, but that's where we are right now. So what do the big research shops make of all this? The general tone across Wall Street right now is cautiously optimistic. Several major research houses have actually raised their year-end targets for the S&P 500, and the common thread in the reasoning is earnings, particularly from companies tied to the AI infrastructure build-out, which some strategists estimate could account for roughly half of this year's earnings growth. But even the optimists are flagging cautious signals. Momentum has run hot, and market leadership remains very narrow, meaning it's just in a few stocks that are kind of pushing the markets right now. The other theme I keep seeing is in the research is discipline. One mid-year outlook I read put it this way: the challenge for investors this year isn't picking the right headline to react to. It's not reacting at all. Headlines keep causing pullbacks, and those pullbacks keep being followed by recoveries. The consistent advice is stay disciplined, stay diversified, and use volatility to rebalance, not run for the exits. And that theme that theme of concentration risk keeps coming up too, that narrowing that we just talked about. When a handful of big tech names is driving so much of the market's gain, diversification beyond that narrow group matters more, not less. This environment is exactly why we build portfolios around a plan, not around predictions. Nobody knows what Wednesday's CPI numbers will be. Nobody knows when the strait kind of reopens. What we can control is your allocation, your income plan, and making sure short-term money isn't riding a long-term risk. Record highs are also a good reminder to rebalance. If stocks have run up, your portfolio may carry more risk than you signed up for. That's not a reason to panic. It's just a reason to kind of review it and take a look at it. So if you have questions about this or anything else, please don't hesitate to reach out. We always look forward to talking. I hope you have a great day. Thank you.